So Pawan will be joining us in a few moments. So maybe we can begin. And thank you so much, Akhilesh and everyone for joining in. We For the IVCA Green Future series, today's title is Enabling Capital Flows and Returns Across India's Green Sectors. And we have some amazing speakers lined up with us for today, starting with Akhilesh. Then we'll be having Shri Pawan Shah of IFSCA. Then moving on to the fireside chat, we'll be having Andre Rotaru of Stride Ventures and Craig Gifford from BII. And then for our panel discussion, we'll be having Abhay Sagar of MNG Investments, then Harsh Singhal of Prosperate, and Starleen Sharma of Green Artha. And then we have, for this panel, we have our moderator, Sanjay Bansal. And then for the closing remarks, we'll be having Pratibha Jain from Everstone. So if anyone has any questions, then they can drop in the chat box, and we'll be taking these questions towards the end of the dedicated panel discussion or the fireside chat. Thank you so much, everyone. And now I would like to hand over the stage to Akhilesh Tilotia. He's co-founder of Tharo and also the co-chair of IVCA's Climate and Sustainability Council. Over to you, Akhilesh.
Thank you, Mudit, and good afternoon, everyone, and a very warm welcome to the IVCA's Green Future series, Driving Capital Finance for a Viksit Bharat. On behalf of the Climate and Sustainability Council, I'm excited to welcome you all. Before we move ahead with today's proceedings, I have to put in a plug for the Green Returns event that is coming up in New Delhi. This will be our second Green Returns event after the event last year. This year, mark your calendars for November 24th and November 25th. For the event today, Mudit has introduced the speakers. I would like to specifically thank all of them for being here. Specifically, I see Pawan from IFSCA has also joined in. Thank you for bringing in the regulatory perspective as part of today's conversations. I think one important point for us to note is that this Green Future series that we have put together is a series of conversations across a large number of participants. So we try and put together LPs, GPs, companies, regulators, advisors, etc. together. Please make these forums your own. If there are ideas that you want to bring to the table, if there are topics that you want to discuss, please let our team at IVCA know. Happy to put some of them together. We love to co-design some of these conversations, which are of use to the wider community. And thank you all for making this possible. The Green Future series is IVCA's platform to spotlight some of these critical themes in climate, sustainability, and capital flows. And today, I think the session entitled Enabling Capital Flows and Returns Across India's Green Sectors is an important one. And we are seeing IFSCA becoming an important pivotal point from where we will see cross-border capital flow coming in and innovative financing models coming in. One of the things that we have seen is that the aspect of climate finance requires significant amount of global capital. There have been lots of conversations and calculations to showcase the amount of capital that is required for India to move towards a peaking and eventually towards a net zero. And in many cases, it is very clear that the amount of capital that will need to get generated is not necessarily all available in the local ecosystem, and hence cross-border capital is important. And as cross-border capital comes in, the sort of financing models that are required and the innovation that is required in parceling out the right risk to different sets of people is an important one. And those are some interesting things that we can potentially do with the regulator at IFSCA. There have been good conversations with them and engaging conversations with them, and we look forward to hearing from Pawan and IFSCA on that topic. I think for us today, if we get a good sense from our investors, the GPs on the group here, to see what they are seeing with respect to the capital flows, how they are seeing the return profile change, how they are seeing the policy alignment happen, and how they are seeing innovation happen at the grassroots. That will be very useful. I know we have technologies like battery storage, SaaS platforms, digital twins, etc., that are being showcased today and are being spoken of today. Look forward to hearing more about them as part of today's sessions. What we want to do as part of all of our conversations is always to inspire confidence among investors. IVCA stands as a bridge between policy, capital, and innovation, and we want to bring all of you folks together, as I mentioned. And with those words, I would like to now welcome Shri Pawan Shah to deliver the keynote address and talk about IFSCA's vision for enabling cross-border green finance. Thank you, Mudit and all, for organizing this, and over to Pawan for your comments.
Good afternoon. Hope I am audible. Thank you so much, Akhilesh, and I'm happy to be there and be with all of you. So normally I've been as in addressing most of you in last 4 years in my capacity as a policymaker for investment funds, and I'm happy that the other hat which I also wear at IFSCA, the Sustainable Finance Hat, and today is the time to talk about more from wearing that hat as compared to what we do related to investment funds. And as we speak, and Akhilesh rightly put out that context of cross-border capital which can flow into India through GIFT City. Before we go to our specific initiatives, what all we have done and what all we have achieved, let me share with you the high-level context within which we operate, right? While India has committed to net zero by 2070, there have been different estimates, again, with respect to the capital that would be required to enable India to be net zero by 2070. But if you look at any of these estimates, largely it has been revolving between $10 trillion, 15 and to $15 trillion. Definitely significant amount of capital which is being talked about. Now, even if we break it down and don't look at the larger horizon, but just look at the next 5 years, again, in terms of India's NDC targets and India's commitment, if we look at the total capital requirements year on year, at least even for the next 5 years, for adaptation, for mitigation, for disaster recovery put together, again, broadly on a year to year basis, up till 2030, we need about $270 billion of capital every year. And if we look at the actual funding, it stays between 50 to $70 billion, right? The gap, even as we speak right now, is significant. Now, within this 50, $70 billion capital as well, which comes every year, again, about 83% is all domestic capital, and international capital is restricted to about 15 to 17%. So if we look at this larger context, of course, there is a significant amount of capital gap. Uh, Institutional investors from foreign jurisdictions are yet to contribute significantly towards these areas. And this is where we see IFSC has a role to play. The other two larger stories, while a lot of countries, a lot of corporates have going back on their commitments, it's happy to know that India has been out there agreeing to whatever it has already committed and not going back to its commitment. The other part of capital requirements need, right? The government of India has laid out a very large mandate of being a developed country, or as we call it, Viksit Bharat by 2047. If that dream has to be true, then a lot of Indian corporates have to be global champions. And for them to be global champions, they need to have efficient capital available at their doorsteps. And when we say efficient, the cost of capital has to be significantly lower to enable them to be those global champions. Again, there, IFSC will have a significant role to play. So looking at this larger picture, what we have been doing over last 3 to 4 years is to enable capital for the Indian corporates through various means. Sometimes nudging the market participants, sometimes coming out with new policies, and sometimes with mandating certain practices. And we have taken this initiative, as in most of you would know, IFSC has been into existence only for 5 years practically. So it's a new jurisdiction, a new regulator, and practically nobody would have expected us to take so many steps, even in this area of sustainable finance during our initial journey. But we have taken this very seriously. We have embarked upon a journey where we want GIFT IFSC to be a hub for various sustainable finance activities, be it through debt capital, be it through funds, be it through equities, or be it through any other mode, including bank lending. In all those areas, we have taken significant number of steps, and at least in some of those areas, the results are visible. So what we have done to start with, at least for debt capital, Indian corporates wanting to raise debt capital, way back under our listing regulations of 2021, we enabled raising of capital through green bonds, social bonds, sustainability bonds, and sustainability linked bonds. Recently, this year, just before a month or two, we came out with a framework for transition bonds as well, knowing that a lot of our corporates, while they are committing, it will take some time. They are from those hard to abate sectors where immediate technological solution may not be available. But then there are commitments, there are transition plans. We have came out with a framework for transition bonds as well. And across all these GSS plus bonds, or the labeled bonds as we call them, uh, the total listing in a short period of about 2.5 years has crossed about $15 billion. Out of total debt listings in IFSC, the ESG labeled bond market itself is about 25%. We are also cognizant of the fact that in today's time, because of no regulator would want any incidents of greenwashing, and the requirements have been tighter and tighter, greater disclosures are being warranted. There is a third party audit which is generally warranted. All of it comes with an additional cost. And earlier, everybody used to think if there is a green purpose, there could be a greenium which would be available, reducing the cost of capital for the issuers. But practically, we are seeing greenium not being existing, not just in the Indian market, but even many of the global markets as well. In that context, we are also we have initiated conversation with Government of India, where at least the issuers of labeled bonds, there are certain fiscal benefits which can be given. We have seen different jurisdictions have done it in a different manner. So something on that front, we have started those discussions with the Government of India. If we look at the banking channels, we are perhaps the first jurisdiction which has mandated the banks in IFSC to give 5% of their total loan towards green, social, sustainable, and sustainability linked sectors as well. And in a short time period of 1.5 years, what we have actually seen is a total lending crossing $4 billion towards these sectors. So that has been another progress on the banking side, which we have also seen. The other piece, which is closer to the audience, which is there today on the fund side, what we have also done during our initial journey is certain requirements at the fund level we have mandated. So if sustainability related risk and opportunities are being factored into any general fund, then we would want the asset manager to disclose it, whether they take into account or not. And even if they mention that they do take into account those sustainability related risk and opportunities, we want a granular level disclosures of how they factor in. This is for any alternative investment fund or a retail fund which is being set up in GIFT. Separately, while this is a international financial center with light touch principle based requirements, let me be upfront. There has been one area where we have been actually very granular, has been related to ESG funds. Any fund which classifies themselves to be a E, S, or G fund, or probably having similar name in its fund, or probably market itself as an ESG fund, they need to adhere to the granular level disclosures which IFSC has specified. And unlike the domestic market, unlike any other foreign jurisdiction, these requirements are not only applicable for retail schemes, but we have also mandated it towards institutional funds. So AIFs which are set up in GIFT, which are of institutional nature and still classifying themselves as an ESG fund, they have to go through granular level of disclosures initially on a continuous basis. And also there is a monitoring requirements which is placed on the fiduciaries in case of such ESG funds. Happy to share that in a short time period of 1 year, we have seen 3 ESG funds which have also been set up in GIFT. And there's one more impact fund which has been set up by a large global corporate for investing into the Indian market. It has been what we have also done to incentivize the market participants. While unlike many other jurisdictions, there are no fiscal incentives, or nor as a regulator we are reimbursing any expenses. But what we have also done is at least the regulatory fees which are applicable for any fund, and largely for a fund investing into listed securities, the fees are something about USD 22,500 for the regulator. At least those fees we have waived off for a fund which will be a ESG fund in IFSC. And this waiver is available only to the first 10 ESG funds. So any of the participants who are keen to set up any of those funds to pool money from global investors and to invest into the Indian markets, this is a limited window which is available. Please use that window. Separately, again, since we are on fund, let me also share this. What we are also working on is a proposition towards a blended finance. We know there are a lot of projects which may not be viable on its standalone basis. And if there is a concessionary capital which can be blended with a commercial capital, and the best scenario could be through a fund vehicle, where could be maybe a waterfall mechanism, a different mechanism which could be made available to the investors. They can make use of the ecosystem to do genuine investments towards this sector. So we are working on a consultation paper towards it. We will come out with that consultation paper probably in next 15 to 20 days, where we will be seeking views from all the market participants. And then under our fund management regulations, we will enable something towards a blended finance proposition. Lastly, in whatever we do, we would definitely not want greenwashing to take place, as in whatever it's early days of our journey as well. We would not want anybody to use this ecosystem, label something as green, and do certain activities which may not be towards the intended objectives, nor in terms of their own disclosure. So last year, what we also did was came out with a framework, which is a principle-based framework towards mitigating the risk of greenwashing. We have come out with 5 principles. Within those principles, we have given detailed guidance notes and illustrations towards what may also constitute towards greenwashing. And then the regulators would take action if any of those activities within GIFT is being viewed uh, in terms of as in adverse to the interest of the investors, and not in terms of the regulatory objectives, nor in terms of the disclosures made by the entities. Together, we believe all this, as in our initiatives across the banking channels, across the fund channel, and then towards the bond market, will definitely help bring in a lot of global capital for investments into the Indian market. We, on our own, have started conversations with a lot of impact investors from outside the world. We have been talking to sovereigns as well, where they could also support some of these initiatives, including issuing bonds, including participating as first investors into various blended finance proposals which would be available on the table. I think we would continue to take more measures. We are all ears if you have any other suggestions where we could support this important goal of India to be net zero by 2070, where global capital is required and our policies are still not in place, or if the expectations are something more, we would always be open to hear those ideas from all of you and take forward those policy suggestions. Thank you so much.
Thank you so much, Pawan sir. It was really insightful for everyone to listen to what IFSC's plans are and what they have been doing in this, and what's the road ahead. So just wanted to know, can you take a few questions? I think we have a few questions in the
Sure, I can respond to that. So one query is about ESG fund and an impact fund. So impact fund would also be a part of ESG fund. That's a laid out strategy. There are disclosure requirements which have been made applicable. There is a IFSCA circular which probably I can share with Mudit, and you can also share with participants as well. That circular gives a complete requirement in terms of what are the regulatory expectations. So I believe Haresh and the anonymous attendee, this would help clear the expectations out of those ESG funds. If possible, I will try to share the link as part of this chat itself, which will give you access to that ESG fund circular.
I think Starlene has a follow-up question asking, are there any mechanisms between India and GIFT to avoid double taxation of foreign investors?
Thank you so much, Stalin, for asking this important question. In fact, generally the DTA arrangements which exist are with foreign geographies, which are always subject to interpretations and as in tax issues, which generally foreign investors may end up in future. What good thing we have been able to do while working with government of India is every instrument which is available in gift, be it a bond or a fund, the tax treatment for the investors is hard coded under the Indian Income Tax Act. So all those things are not subjected to any treaty. Those are not subjected to differential treatments or interpretation. There is a clear tax treatment which is available, and then depending on certain geographies, sometimes there are mechanisms available where you are not taxed in both geographies. So those tax treatment do take into account, and it depends on which is the instrument through which the investors are investing into the Indian markets.
Thank you so much. I hope, Stalin, this answers your question. And we have one more question coming up. Please let me know when you need to. We have a question from Neelam Pandita from Black Soil. She's asking, will the reporting done as per IFSC framework be acceptable by global DFIs and LPs?
Sure. So, in fact, what we have done, very good question, I would say, and we were cognizant of this fact, Neelam, when we laid out our framework. So, what we did was for every framework, again, be it bonds or funds, we have done a global benchmarking. And especially with respect to bonds, what we have actually done is we have looked at what would give the comfort to the investors. And in our interactions with the issuers, what we got to know is if issuers are looking at investors from European region, generally, as you rightly pointed out, they'll be comfortable with the disclosures under the EU taxonomy framework and meeting those guidelines. Similarly, if the investors are under from the Asian geography, they are more averse to the Asian taxonomy. So what we have done under our framework is we have given wide bouquet of uh, guidelines and principles and taxonomies which the issuers can choose for making disclosures to the investors. So depending on your set of target investors, you can report under those framework, and IFSC has not reinvented a new taxonomy or a new guideline framework, and it has been working well for all Indian issuers looking at global DFIs and LPs. As far as funds are concerned and their reporting, again, we have looked at the IOSCO principles. IOSCO, as you would know, is a central agency where all securities market regulators across the world, they work together. They come out with a common minimum framework guidelines. And whatever was the expectations under the IOSCO principles for ESG labeled funds, especially in terms of their disclosures, we have exceeded all those requirements. In fact, we were one of the first jurisdiction which voluntarily accepted an independent assessment by IOSCO on our framework as well. So by and large, at least in our experience, both across funds and bonds, it has been working well.
Thank you so much. This was very insightful from you. And Luisa Monereto, she asks how family offices and private equity funds from Europe can co-invest in the Indian green economy through the Gift City, and what are some main verticals of green economy in India?
Sure. So if you look at the how you can co-invest into the Indian economy through Gift City. So at least in a fund structure, what we have enabled is there are different LPs which participate generally in a fund. Separately, if there are any particular specific investment opportunity which a particular investor wants to avail of and put in greater amount of capital, then through a separate SPV vehicle, we have permitted co-investments into Indian companies through the Gift City fund structure as well. So at least it's an easier route which is available, and we have seen many takers about it. So at least through those structures, we have seen how uh, foreign family office or private equity would be putting an additional amount of money into the Indian companies as co-investments. I don't know if that was the specific query or there was something else to that question, but to the best of my understanding of co-investment, I tried to answer it from that perspective. Please clarify if the idea was something else.
I think Luisa has follow. Yeah, she's saying that it's clear to her.
Excellent.
And there are two more follow-up, two questions. Would you be able to take them up?
Sure, we can take this too. So
So,
Nishant is
yeah.
saying, will there be any change, modification to the existing plug and play model norms? So, Nishant, I would believe you are asking about the third-party fund management services norms, which have been notified just a month back. And let me clarify with all of you. At IFSCA, what we have been doing is not to change our regulations on a very frequent basis. In fact, we are perhaps again one of the only regulators in India and globally as well, which has mandated on ourselves, as in we have a regulation for us how do we make regulations actually, and that regulation mandates us to review all our regulation once in 3 years. And during this review exercise, what we also do is do a complete public consultation. Those public consultation are not just on the principles, but those public consultation are actually on the proposed change in the law as well. The draft language of the law is made out for public comments. So any change in the regulations, definitely without public consultation, will not take place. And unless we feel there is a strong reason from our side to change something, or probably if there is a strong need from the market where we don't see any regulatory arbitrage or any issues, only in those cases probably we would review those regulations again. But as I said, it will always be with the
Thank you so much, Pawan. So I think this answers the questions. And I think we are reaching your panel time. So thank you so much for for the detailed insights that you shared with everyone. And it was indeed quite insightful for everyone, even the panelists, and for all the attendees to listen to your deep insights. So thank you so much. And as discussed, we'll be sharing the circular that Pawan sir mentioned with all the attendees post this webinar. So please feel free to, yeah. Thank you so much. And I'll be sharing across the information. Thank you so
Thank
much,
you so
Pawan.
much. I'll try to share it in the chat window itself. If possible, I'll try to share the circular as well in the chat window. And separately also I'll share with all of you. Thank you.
Sure. Thank you so much, Pawan sir. So now moving on. So firstly, thank you so much, Pawan sir, again. And now moving on, we have our fireside chat discussion between Andre Rotaru from Stride Ventures and Craig Gifford from BII. So on to you, Andre and Craig. Thank you so much, firstly, for joining in for this webinar, and over to you.
Hi, Mudit. Hi, everyone. First of all, thank you so much for having me here, Akhilesh and everyone. Very glad to be here. Hopefully, my insights will be useful for everybody attending and also for the broader context. So I'm very grateful to be here.
Hi, everyone. It's also a pleasure to be here today. Thanks to IVCA for organising this and inviting me to join this fireside chat today. Look forward to it.
So Andre and Craig,
Right,
like to just to begin, would you like to have a brief introduction of what work you both are doing at Stride and at BII, and then maybe we can move on to the point of discussions that you may have for this.
Sure, happy to. I'll start if you don't mind. So, my name is Andre Rotaro. I am a partner at Stride and also the Chief Impact and Sustainability Officer at the level of Stride Group. And as part of that capacity, I'm focusing on investments, origination, but also creating new sustainable products for Stride, which has a long history of doing venture debt in various sectors, including those that are climate related, like clean tech, but has not as yet launched a specific either ESG or impact fund, as Pavan would call those, are under IFSC. So part of my work is that. And the other part is looking at the developments internationally outside of India for Stride, where we can take our know-how and our skill set globally.
And I'm Craig Gifford. I am a portfolio director on the private equity funds and co-investments team at BII. I've been there with BII for about 20 years now. BII, as you know, is owned by the UK government, and we are a primary vehicle for delivering sort of climate finance to emerging and developing countries. We have I guess, three impact priorities. One is around productivity, so job creation. The other is about inclusion, and the third and the growing importance one is around sustainability there. And so in the last sort of 3 years, we've been investing about $2.2 billion into climate across Africa and Asia. Alongside that, we've mobilized about 1.1 billion. And in India, we have sort of in the last 3 years invested about 700 million towards climate related projects, of which sort of 330 of that is in the EV area. And so specifically, I look after funds, and a big focus for us on the impact side is identifying more growth stage private equity funds, which are focusing on the climate side. We have a separate team that do look after sort of VC and look after the venture capital ones, which are also looking at climate, but I more look at the private equity ones.
Thank you so much, Andre, and thank you so much, Craig, for for the introduction. So now we would like to go question by question. So maybe let's start with Andre. So there are some point of discussions that Andre mentioned that he would like to take up in this webinar with everyone. So Andre, to begin with, with your discussion with Craig, would you like to touch upon climate specialist versus generalist doing climate, and according to you, what is more attractive?
Happy to. I mean, to be fair, this has been a pendulum over the last, let's say, 10, 15 years. Originally, when I started in the industry about 21 years ago, there were only generalists, and the only, let's say, climate specialists were impact-only funds that were more on, let's say, CSR initiatives than actual private equity funds. But then over time, the industry evolved, and until I would say probably 5 years ago, it was very common to have climate specialists, ESG specialists, climate specialists. US was actually leading that, and then Europe followed with net zero initiatives. So we had a lot of traction there. Now, in the recent times, what we've seen is a bit of a pullback, and I think Pavan was talking about that too. The pullback started in the US, and then some European institutions also followed, mostly banks. The net zero goals were pushed or relaxed. And so what I see today in the market is more generalists that have a, let's say, a climate angle to some of their investments than pure specialists. And also if we talk to people like IFC, and I'm sure BII has the same statistics, they tell me that in their books, the generalists have done better in terms of pure IRR and MOIC than the specialists. And so that's an interesting finding. For myself, I personally believe that there's benefit in specialization. I believe there's a benefit in depth of bench and depth of knowledge going into these sectors, especially when we're talking about emerging markets where there's a lot of regulation to be put in place. Maybe the incentives are not as clear as they are in Europe, and so you have to take certain risks. And in order to take those risks, you need to be able to have a very deep knowledge of the sector. But it would be great to see what the LP says about this. So, on to Greg on this one, because, if you cannot raise the fund, then all of this is irrelevant.
Yeah, look, I think look, we used to invest only in generalist funds. We, as Andre mentioned, look, we have done a lot of specialist funds, and the results have actually been mixed in it. But look, the generalist funds have actually been investing in green finance for sort of the last 10 plus years. Obviously, they sort of see the support from the government and from regulators, like Pravin was saying before. As a policy, there's lots of demand for investment as well. Yes, it is going through a slight pullback at the moment, but like the renewable energy sector, which has seen the sort of the lion's share of the capital, is going to continue to grow in India. You're seeing the emergence of the e-mobility areas, and there's lots of other up and coming areas like the battery storage, circular economy, sustainable technologies that have been evolving in India. There has been a funding gap, particularly on the growth side, but actually, and the generalists are looking at this space and tapping into it selectively, and so we see that generalist part continuing. But what we've also noticed is actually as the landscapes evolve, we're actually seeing more specialist climate funds coming up. Initially, that was on the VC side. Some of the infrastructure funds too were naturally sort of evolving around that or investing into particularly the renewable space anyway. We're now starting to see generalist funds more on the growth equity side starting to come up there. And while some of these are first time teams, we're actually seeing other established PE houses looking to say, well, actually, should we create our own climate vertical and actually raise that there? And so that's quite interesting for us because they're not looking at this as from a sort of a necessarily a climate first perspective. It's actually they see that they can generate strong risk adjusted returns there. They're trying to do it into areas they've already invested into and developing those capabilities, but they're now seeing that there are some of these sort of more nascent sectors or segments within the climate space actually evolving there. And so it's quite interesting. And then that will allow them to then diversify at the portfolio level, the risk across different sectors. So we are seeing the market evolve. And we see that that's probably going to continue there. We're seeing that there is a potential gap on the funding side, which is always good from an entry point of view to allow some of these businesses to actually grow. But then I think it sort of has been sort of touched upon earlier as well. We need to sort of think about, well, how there is still a perceived risk there, and there is some risk there. So how do you use blended finance? How do you use different structures to get people into some of these things? And another thing for us when we are looking at specialist funds, particularly in the climate space, is around sort of the greenwashing risk, which we can touch upon a bit more later. But for people like BII who have this as a core mandate run by the UK government, we really have to make sure that we are mitigating that risk as much as possible. It's good to hear the regulators are also doing that as well and putting that place. But as an investor, our responsibility is also make sure the GPs are doing it as well. So I think the generalist funds will continue to do more in this space because commercially it's attractive. We have had some specialist funds that have done very well in this space on the climate side. But it's harder. You're taking on a more concentrated risk. You can't diversify that at the portfolio level. So there is a risk from a risk adjusted return perspective at the fund level of having some underperformance there. And so I think it'll take time, but we could see some development in this area over time.
This is great, Andre and Craig. Perhaps maybe if I can invite you both to take this discussion ahead and share your perspectives on, ahead.
Sure. So I mean, to Craig's point, right? When you do climate only, or forget about climate only, when you only select a number of sectors, especially if you're also single country, then obviously there's a lot of concentration risk, right? And then the macro environment takes its toll. And to that point, I believe that blended finance initiatives are very, very important, especially for specialists. Yeah. First loss structures, various other types of structures give international commercial investors a lot more confidence that their returns will match up because the reality is in today's world, you don't get a break in terms of returns just because you're doing climate or because you're doing ESG. Just like you don't get a discount in bonds, in green bonds, or much of a discount in green bonds, you don't get a break on returns either. So then essentially your returns have to stack up. And on top of that, you need to layer actual ESG and impact indicators that are objectively and thoroughly collected, benchmarked, and then presented to the investors. In Europe, the structures are a little bit more settled. You have Article 9 funds, you have Article 8 funds, so you can choose. It's vetted by the regulator, then you know where you're standing. In places like India, it's a nascent industry. I think the work being done is amazing. We're getting there. But until then, in a way, and this is my view, and Craig, please step in. I think it's up to a certain point to the DFIs and to the let's say the strategic investors to also vet that part and to make sure that greenwashing doesn't become a practice just to add a little bit of capital to what you're doing already, but rather it is another core part of your investment mandate as an asset manager that not only brings diversification but also allows you to step aside from the crowd.
Yeah, I think just tapping onto that, what Andre was saying was, I do see that DFI's multilateral impact investors foundations play a role there. It is a focus for all of us, I think. I've rarely seen one who isn't focused on the climate side. We have different pools of capital. We can also provide the first loss as well, provided it can mobilize capital there. And there is quite a large supply out there looking to do that. The condition is it's got to mobilize commercial capital. Now, the GPs are pretty confident that they can deliver risk-adjusted returns. There are examples of underlying investments that definitely sort of stack up there. How does that look at a portfolio level? And so it gives comfort having this blended finance in there. And if that helps attract the capital, that's great. Longer term, as Andre is saying, you can't rely on that. Hopefully, it's never used. Hopefully, it's a safety buffer there. But you need to, and I think we've seen this across the Indian industry and even in the impact space as well. You need to deliver DPI. Nothing takes away from the commercial aspects to actually make that work. I think on the other thing sort of raised there around sort of what we look for when we are looking at say climate funds or impact funds, particularly climate ones. Our underwriting is the same for the commercial side. There's nothing different there around the strategy team, track record, etc. And obviously, ESG has definitely become more mainstream in India, and it's moving from more of a compliance mindset to actually this can actually add value and preserve value in the portfolio there. But when we're looking at climate, going a step beyond that there's probably two areas we really spend a lot of time on. One is around the intentionality. And so are we aligned with the manager on the intention? It's a softer and more subjective area, but we need to make sure that the GP is thinking the right way about climate, how they're behaving, how they're discussing it. Do they have any track record in the climate space that we can then sort of get comfort that if they're investing a blind pool that they will follow that. It's also the expertise within the team. This is probably one area where we do spend a bit of time with the ones who are looking to raise is what's your expertise in the team and actually at the IC level as well. Having someone who has experience of investing or managing climate risk, they're going to ask the right questions and actually make sure that the investments being made by that particular fund are qualifying for climate there. And then actually on their investment process, like how is climate integrated into the full investment cycle? That's from origination to screening. Are they thinking through sort of measurable impact targets? That's both at the fund level and per investee. The targets can differ or should differ between different investees. Post-investment, sort of how that's being monitored, how are things being course corrected post it, and equally critically on the exit, how is the manager going to think, or are they thinking about climate risk and that continuing once they exit the company there? So this is just some of the areas that from our perspective we look at before going into a fund, and this in simple terms is how we sort of mitigate that we're not putting money into something which is going to be seen as or has a risk of greenwashing down the line.
No, that's great to know, especially because the reality is that if done right, climate and ESG can actually increase the value of the company at various stages. Especially if we're talking about, let's say, early stage or growth equity companies, you have several funding rounds. And in order to maybe raise the first money, that is not necessarily an issue. It's more about the commercial traction and everything else. But as you're going into the latter rounds and you're attracting the more global institutional investors, this is more than a checkbox. It's something that you should already have in place, and you cannot start at the moment of raising the round, because that's the definition of greenwashing, right? You have to have actual collected data and done it with purpose before. And especially if the IPO is the exit route, then there's a proven premium there in various markets for companies that do this right. Now, the challenge on the GP side is that, as Craig was saying before, there was a time where this was done mostly by generalists, and then lately some specialists have come up. Now, by nature, those specialists in the definition, the strict definition, are first-time funds. Now, for being a first-time fund in today's fundraising environment is incredibly difficult. We all know this. And it used to be a time when I was at IFC, for example, when DFIs would actually favor first-time funds and first-time teams versus fund 2, 3, or 4, simply because there was where the developmental impact was maximized. Now, what I find sometimes in the market is that even DFIs shy away from what they call first-time funds. And so the only real solution is to be an established manager that has done maybe 5, 6, 7 investments in a certain space speculatively or opportunistically, and then package those as track record and do your own fund. So it would be great to understand from your point of view, Craig, how do you manage that, right? The need for new managers that specialize in this, but then the first time fund hurdle, right, which is a big one for all of us.
Yeah, look, I think just on the first time fund point to start with, look, we still do look at it. However, it's very selective. And the reason we used to do first time funds, frankly, there were no other funds in the market. Now there is lots of funds in the market. Now there is a good supply there. Why take the risk there if you don't have to? In saying that, in a space like climate, do you take the risk that a GP is genuine about shifting to climate? Or is it just purely opportunistic in order to raise more AUM, more fees, etc. there? So that's where the intentionality, the alignment comes in, particularly for the non-first time funds, where they're trying to raise a thing. So it's not a straightforward answer. We spend a lot of time there, but we will add a first time fund where there is a gap in the market, and there probably is not an established player that we can back to address that opportunity. If you've got two proposals next to each other, one's established, delivering on it, one's a first-time manager, the risk on an established manager is going to be lower, and you can assess that much easier. So we are still doing it. We recognize we have to take on that risk, but it's not so much a factor of do we want to do first-time funds or not do first-time funds. It's where that market is at that point in time.
This is great, Craig and Andre, from both of you. There are some questions in the question box. Would you be able to take them up?
Sure.
One of
Do
the
you want me to
attendees.
start, or shall I let Craig? I think a lot of them are for Craig.
Are they? Okay. So on the question around, I guess there's one around sort of categories of climate, and so one is just around the supply chain for the renewable sector, playing a role there and broadening that. E-mobility is a big focus for us. We do see at the stage where it is at the moment and the risks there, that it's a good role for BI to play, to invest that, and that's across the supply chain from the manufacturers of the parts to the OEMs to the charging station. So there's a whole range we can play there, to the financial the circular economy side of it, to even sort of green lending and finance as well. So we see opportunities there. Obviously they will vary depending on which segment you're talking about, and we will address some of those with equity, some of those we'll do through funds, some of those we'll do with debt, depending on the profile with the product which is actually best suited there. But those are some of the areas that we would like to do some more there.
Just on the e-mobility question, right? So are we bullish on the e-mobility sector in India? So Stride has financed 5 or 6 e-mobility players. That's the beauty of being a debt provider, right? You can finance competitors at the same time, and that there's no issue there. So the very short answer, yes, but there's a lot of nuances to it. Like any sector that's booming and where there's a lot of government support behind it, there's a lot of players emerging, and only a handful of those are going to be winners, especially when we talk about OEMs and vehicle manufacturers and assemblers. Personally, and also I think that goes for Stride, we're more excited about the infrastructure around it. where no matter what vehicle you use, you're going to need the charging infrastructure, you're going to need the battery change, you're going to need all of that, especially in the B2B sector, where we feel that there's no going back and it will be electrified. I think the last mile delivery, whether it's on 2 wheels, 3 wheels, or 4 wheels, will be electrified. Greg?
Yeah. Yeah, that makes sense. Should I go on to the question on the fundraising? Look, it's been a slowdown on global fundraising for a while. I think part of that is linked to returns that people can get, high interest rates, I guess, in the US, etc. Returns they can generate in their own local markets. A lot of the international investors have the choice of where they invest geographically. And the unfortunate thing is, I think India is still recovering from legacy challenges on the investing side. So it still has been difficult to raise international capital, at least generally. In saying that, there are some established larger funds which are being quite successful in their fundraising. If you put on top of that an impact mandate, be it like we invest into as well on the inclusion side or on the climate side, it is still very nascent, and trying to then attract capital into India, for at least for commercial investors, is challenging. We're putting efforts into that to try to help mobilize that. We think the blended finance structure can help along that way, but nothing will speak more than actually the GPs to deliver on track records and actually generate returns, generate carry there. But it still is a difficult market to fundraise generally, and we've seen sort of reduction there, I think, globally.
Yeah, just to add to that, I think, if you talk to global allocators, the biggest reason in slowdown, let's say, new allocations to private equity and venture is the lack of DPI. DVPI is less of a problem, but paper money is less and less valuable in the books of allocators because they tend to now have 2, 3, sometimes even 4 generations of a certain manager still on the books because of the lack of exits. And now that the M&A has picked up a bit, and I think India is a place where actually exits are easier to come by, and the IPO market is booming, and you have a lot of activity. But globally speaking, the slowdown is still there. And so for an allocator, you're just becoming over-allocated to the asset class by the nature of not having enough exits. I think that's the truth of it. And that's why secondaries are so popular and have been so popular for the last few years. That's why credit has been so popular, because you essentially have shorter J curves and structured exits in a way or another. Greg, do you see that in BII too, in your portfolio, the lack of exits and the need for more structured exits, or isn't that's not really a concern?
We are seeing that. I think we're seeing an increase in exits, and I'm talking relatively here from the past. And GPs are now taking the opportunity when it arises, but it's taken a lot of effort from the LP base to actually really put the pressure on, and for the GPs to see the light there. They still want to maximize value versus taking the only exit opportunity that will come because that company hasn't performed well there. So we are starting to see an improvement there, and we're seeing funds now, GPs in their more recent funds, take exits more opportunistically. It's still they're still hesitating because the multiples may not be as good, the MOIC may not be as good, but the IRR is pretty good. And I've never seen a GP get penalized for taking money off the table. And so we're now starting to see that shift there. So we're seeing an improvement in some GPs who have really understood that. But I would say the majority are still yet to sort of fully execute on that.
Makes sense.
Thank you so much, Craig and Andre. And I see we have got some excellent questions coming in. But I think in the interest of time, I guess we'll have to move on and we'll try to address them offline.
Great. Thank you very much.
Thank you so much.
Thank you so much, Andre and Craig, again for joining in. And now moving on, we have our panel discussion, for which I would like to hand over the stage to Sanjay Bansal. Over to you, Sanjay.
Well, thanks, Mudit. Good afternoon, everyone. Welcome, panelists. Welcome, Starlene. Welcome, Harsh. And welcome, Sagar. I think what we've heard a lot of the panelists speak earlier today in this session is about the opportunity, right? And the framework which is being created for what I'm calling climate to green capital investing. The topic for today, which we were allocated, was more on the technology side, right? How technology is helping scale up. I'm going to expand this a bit, actually substantially a bit, to put a context around, what is really happening in the climate tech investment world in India, right? And I'm going to walk through all the different facets for the benefit of the audience. Uh, for that, we have three panelists, like I mentioned. Starlene Sharma, she runs Green Artha, one of the very early climate tech platforms, very well established, deep insights on what's going on in the market. Uh, we have Harsh Singhal, who runs a partner at Prosperity. Harsh comes with very deep experience at IFC and CDPQ, right? And Prosperity has been created for investment in the climate space. And we have Abhay Sagar, who is a partner at M&G Investments, which is a global platform managing, I think, some $300 billion of investments from various, fund owners uh, based out of Singapore, if I'm not wrong. We did have one more panelist, Sophia Nadur at BP. Unfortunately, we couldn't have her join us because of travel conflicts. We have about 45 minutes for this session. We'll walk through multiple conversations and perspectives with our fellow panelists. We'll throw open this platform to questions for all of you at the end, maybe between 5 and 10 minutes. If there's still follow-ups, we will then take them offline or separately. Let me start, uh, uh, panelists, by asking any one of you wants to answer, and maybe I'll ask Harsh this question. Green capital. What is green capital? Is it climate tech? Is it green infra? Or is it more than that? Because these terms are loosely used and sometimes misunderstood.
Yeah, no, I think thanks, Sanjay. And first of all, thanks to IVCA for hosting such an interesting discussion. And thanks for having us. Uh, so, Sanjay, on your question, I think it's a very interesting point. And, actually, I'll go a step back. Actually, when we talk of green capital, people actually often confuse it with ESG. And I think one context also which needs to be taken into account is ESG is all pervasive, right? It actually talks of how well are you doing in a business. So when we are talking of green capital here, we are talking of anything which benefits the climate, right? So now when we get to this level of climate, there are two aspects of climate, right? One is, are you actually more, on the mitigation side, which basically means that are you actually helping the cause for CO2 emissions, whether you are making sure that, the human footprint actually reduces the CO2 emissions which otherwise are going into Mother Earth, or you have some other methods to, take carbon capture, for example. So that is one side of climate. The other side of it is adaptation, right? Because I think all of us have now realized that climate change is here, and there are already problems which a lot of us and especially people at the bottom of the pyramid are facing. So that is also becoming an important point in terms of how do you help people adapt to such climate changes which are happening. So these are the two legs within the whole climate world. I think it will be safe to say 80% of it is talked about in the mitigation context. Adaptation is something which is recently being taken up, and at least from our perspective, we are finding very good investment opportunities in the adaptation space. Coming to specifically how you describe, Sanjay, I think the opportunities are on all sides when you are doing climate. I think I paint it this way. See, the whole green capital is about putting in money in businesses which take care of the two objectives which I just mentioned, whether on mitigation or adaptation. Now we are talking of infrastructure in great context these days, but actually back in 2008 when the renewable energy business started, it was seen as a climate tech sort of a business, right? And when we invested from IFC in companies, they were like backed by VC funds. And today those companies have evolved into platforms, and those platforms have become big businesses. So that has got classified into infrastructure. If you actually take a bigger view, Actually, what's happened is that the whole energy scene in terms of the power is now being addressed by renewable energy, which is green infrastructure, as you rightly said, Sanjay. But what is also important is that there are other spheres of the economy. You know, the energy we consume, how we move, what we wear, what we eat, all of that is creating climate impact, right? And that is what is getting clubbed under the green climate tech sort of a space, so that more avenues can come in, which sectors can become big, and they create the whole climate impact. So I'll pause here. I think that
No,
hopefully
Harsh, that was very helpful. But if I was to just take this conversation little differently, so we've had enough literature, enough government conversations, enough panelists, this forum, other forum, speak about, how this is a multi-trillion dollar opportunity over the next, 2030, 2070. And when I look back and I remove the green infra part from the equation, and I look at the data over here, to my shock, I realized that the current size of the climate tech market, from an investment point of view, is actually just about $3 odd billion so far, right? Where bulk of the investment came over the last couple of years. I'm keeping infra out, right? So, while there is a big need and conversation, the truth is otherwise. Abhay, any thoughts on this? You wanna hazard a perspective on this? And Sally, I'll come back to you on something very specific which I want to raise with you.
Sure. So first off, thanks so much, Sanjay, for taking time and having me, and thanks to IVCA as well for organizing this. This is a great session. It's always nice to bring the community together to talk about such key matters. So Sanjay, I think you've highlighted a few things, which is the supply-demand mismatch that's perpetually been around. Yes, the opportunity is large. More capital needs to go to it. But I think as you hear a lot of the panelists speak, there's really room for enough forms of capital to come in and take the right risk reward out of the ecosystem to be able to enable growth in the ecosystem. So as M&G, and M&G is more of a later stage player in the market, our intention is, how do we now support businesses that have historically been VC backed, and how do we get them into the next phase of growth, so we can really help them scale from point A to point B. Ultimately, as you kind of get the right unit economics and the right businesses, this will just become a standalone business. So I think that's maybe what Harsh was trying to allude to, which is over time, businesses scale, and they may not just get classified the right way as green finance. They'll just become good investments and a key integral part of the economy. So,
but is it fair to say that today we are at close? The numbers are like antithesis to what we all claim to be the market opportunity. To me, it seems like that's the case in India. Globally, this number is 10x.
Completely. I think there's definitely ample opportunity for us to kind of go tackle these problems and really back businesses that can drive scale. And to me, India in that sense continues to be promised land for opportunities to grow.
Sterling, I went through your website and other material, and came across a very interesting comment right in the beginning, which said, "Climate is a horizontal and not a vertical," and it intrigued me because that's exactly how, at least I think, right? And if you really look at climate, it is climate tech. It has so many subcomponents, and within subcomponents sit different technologies, right? And just for context for the audience, you could be in energy, which has been the bulk of the opportunity in India. It could be mobility or transportation, which is the whole EV story, circular economy, et cetera, right? Love to hear your experience and thoughts on what do you think are these various, while it's a horizontal, what are the subcomponents of this horizontal, and where do you think is the big story today and in the future?
Thank you, Sanjay. And again, thank you, IVCA, and all of the members who've joined today for having us here. We definitively believe that climate needs to be thought of as a horizontal across businesses as opposed to a vertical. to reach the types of climate or emission shifts that are needed to keep the planet in a format that is livable for the economy to function as we currently see it functioning, we're really going to have to see very dramatic shifts in how industry functions and how we're framing this problem. Right now, when we look at India, we talk about a lot of progress having been made against energy because 50% of grid energy is now renewables. But when we step back from that and look at it and disaggregate what energy is actually, something around the neighborhood of 42% of all emissions are coming from industry and its energy use. And that energy use is quite different from the grid electricity because it requires the ability to get very hot. It requires, it's often coming at much higher costs and so forth. So we really see that there's a need to start reframing how we're looking at this and start plugging into what India's economic development is looking like over the next 25 years. India is the fastest growing major economy. And really to maintain and reach that opportunity, we need to be looking at how do we make that transition, that 21x growth in industrial development, be clean as we're building so that we're not locking in a lot of long-term assets that are also high emissions and have a negative impact on India and its ability to achieve that growth. India is one of the 6 most impacted countries globally. But I would say, we've definitively found that there are amazing companies in India that are really kind of up to this challenge, really able to compete with global counterparts in terms of quality. But because they often came up in scenarios of scarcity as they were developing their product, very often have technologies that are much more scalable and much more cost effective. And so we think that shifting the perspective and framing so that climate is seen as a horizontal across all industries is really kind of critical in shifting the needle in terms of what we're looking at investing in, but also the longer term success of the Indian economy. Thank you.
Thanks, Darlene. If I was to just carry this conversation further, if you look at the 2 sectors where 80% of investment is gone, it's really been energy and mobility, which is EVs, right? And I was to step back and think, and I said, why did it happen? Did it happen because there were some unique technologies which came into play? Or it happened because there was a ready market, right, already existing, which had to move from the conventional play into what you're calling, tech related, or climate tech related play, right? And if you notice other sectors like food systems or circular economy or built environment, they've kind of lost out on this, right? Isn't that a dichotomy of the way climate tech should be perceived and technology should be developed in India? Starling?
I think that a lot of the technologies that are coming up across, and we're not looking as much at food systems. We do look at like fertilizer replacements. But I think that when you look at energy and EV, they were areas where we've seen developed markets have a lot of forward thrust. And so it was a much easier fit from a technology perspective. Those economies are not heavily industrial economies. And so their product mix is going to be different. But we do see that even in Western economies, they focus now on areas to try to reduce industrial decarbonization or make batteries more viable, looking at new materials and so forth. And so I don't think it's that these other materials don't have ready markets. In fact, I think in many, many cases they do. It is just what level of nascency are they at, and are they getting the types of financial support and market entry support that they need? As examples of that, we have a circularity company that's using waste to make green chemicals, and they are now outperforming traditional chemical companies. They're a carbon negative product, and they have long-term contracts with companies like Nike, Adidas, Decathlon. And fundamentally, their biggest issue is that even in these markets, they have trouble raising debt while we at the same time hear lots of providers of debt saying, we're here, we have capital, we can't find good deals. And so, it's not that the technology isn't there, it's not that it's not as good, it's that there's a gap in the market that needs to be supported and a shift in how.
So is it fair to say, Starlene, that like in EV, you have battery technologies and charging technologies, and like similarly in the case of energy, you have grid technologies, more renewable and more different solar modules, etc. The same technology impetus is not available in other verticals of the climate horizontal. Is that a fair comment to make?
I think we're starting to see that it is. There's definitely been more discussion around the need for new materials, green chemicals, even in Western markets. And I think that those are coming up in India. They're coming up at rates that are more commercially viable. They're coming up using a tech stack that tends to be more scalable. And so I don't think it is necessarily that there's a really significant handicap. I just think it's a little bit more nascent. And when we put it in perspective, like the first electric vehicle was actually the first vehicle, and that was in 1904. The first solar panel came up in like the 1960s, early 70s, and the first PV cells were in the 1950s. And so these had really long technology development times. Whereas now the technologies that we're seeing, the replacements for green chemicals or new materials for batteries and stuff, are seeing commercialization cycles that are much, much faster. So I don't think that we have any meaningful handicap when looking at a more robust set of solutions to address the climate challenge.
All right. Harsh, when you're looking at climate tech investments, what's your investment thesis? What all are you seeking to look at in potential investee companies? Could you share some thought process at your end?
Yeah, no, I think definitely. But I think before I go back, I just want to reflect back on a few things which we were discussing. I think what has happened in the whole renewable energy or electric mobility space. I think one point which keeps coming back, I keep coming back to, is in climate discussions. It's not about climate. Actually, that's the surprising part. Why do you think we have renewable energy being taken up in with great interest from all the power companies across the world? Because it is the cheapest source of power, and this is the only source of power which gives you 25 years of for energy generation without any inflation, right? Why is there so much demand for electric mobility? Because that is a cheaper way of driving around, right? So I think a lot of what we are talking about climate is actually in some sense also reflects in terms of, especially for countries like India, energy security, and also about efficiency, which is very, very important for us to accelerate in the economic growth.
Yeah, good point.
I think what has helped in both these sectors or in any other sector which are coming up, and it's a normal cycle which happens. You have a technology which is there, like Starlene mentioned. All of them have their own curves, but what is required is an initial impetus from the government, which kind of comes out with a policy framework which helps people start investing, and then kind of take it to a certain scale. And once that scale comes, then efficiency starts to flow in, and then things will start to make sense. Renewable energy, EV to certain extent has gone through that cycle. Other sectors are at different stages of evolution. That's the way we see about it. Coming to how we see investments is actually we realize there is, and it goes back to earlier point also, Sanjay, which you were mentioning, that what's happening in the climate world, it's a very unique situation where a lot of capital is going into companies when they are early. So people have funds where their companies are able to raise $1 to $5 million of early stage capital. And then there are, what you were earlier alluding to, green infrastructure sort of funds, which are willing to put in $50, $100 million of investments where companies have really achieved scale. What is actually missing is this, when companies have proved themselves, they want to grow their business further, and they're looking to raise $5 to $50 million of capital. That is a missing middle right now in climate. So it's the missing middle of growth stage capital, and that's very stark.
Yeah.
So
I'll come to that, Harsh. I'm sorry, I'm going to cut you on that because
Sure.
I want to talk about the whole fund availability in this sector as the next topic.
Yeah.
But if I can request you to throw light on, we're talking about in certain areas, business models which don't exist. We're talking about technologies which are new. We're talking about teams which may be not tested very often, right? Investment thesis and investment underwriting becomes really difficult. And therefore,
Actually,
I just thought I'll ask.
I actually disagree to a certain extent in terms of there is a lot of misconception about climate, right? I think what we are seeing first, I'll take your point on teams. In all the businesses which we are seeing very experienced teams. The people who have actually built businesses, they are now coming across into climate, and many of them actually have done businesses earlier in the whole climate space itself. So I think in our pipeline right now, Sanjay, 80% of our pipeline is by people who have built businesses for 10, 12 years, right? So that is one misconception. In terms of your point on technology, again, I think Stalin mentioned, right? These are technologies which have existed for multiple decades, right? I mean, if we talk about circularity also, it's not something new which we are talking about. I think it's about making sure we are putting it out in the right framework. And at least as a fund, we don't take very big technology bets because we understand it's very important to invest in areas where you actually can create efficiency with already established methods. I think where definitely some amount of if I can use the word conviction is required in terms of business models where you have the initial proof of the pudding. Companies are producing revenues which are growing very fast. In our pipeline, the median growth rate of companies, guess what, is 120%. And it's also misconception to say that companies are not profitable in climate. We have in our pipeline the median EBITDA profitability of companies is 12%, right? So these are businesses which are there. Definitely one needs to take a call in terms of whether with this good grounding can you scale them up, right? From a 10 $20 million revenue, can you make them $100 million revenue? And that's what we actually help these companies for.
And Abhay, would you have any contrarian perspective to what Harsh said in terms of your investment thesis when looking at climate tech investments?
No, actually, I think very much agree with the panel. I'll just maybe put it in like three things or a few things that resonate well with us, and I think it's just echoing what Starling and Harsha said. One, we always wrestle with this invention versus adoption thematic for any business, and definitely in climate. So we think in India, definitely there's a lot of adoption to be done. A lot of the technology's been invented elsewhere, but how can we get the right ecosystems in India? I think ecosystems take time. Scaling it and developing an ecosystem and having comfort that you have the right set of partners, whether it be financing partners, distribution partners, supply chain, and being able to scale along that is very important. And so I think that's where market entry and access becomes crucial. And then I think what Harsh mentioned is fundamentally we're investors who are looking to see what's the voice of customer. Ultimately, the customer dictates the demand. If the TCO makes sense, e-mobility will make sense. If the cost of power makes sense, the grid will buy it from you. And I think to go away from mobility and solar, I think now there's a shift in waste or recycling. As you get the manufacturers of various segments and they're seeing demand from their end customer, whether it be in India or globally, we're increasingly seeing a lot of investment activity that's in our pipeline, but also just from what we hear in the market, where that's changing, right? So you'll see those businesses grow quite meaningfully, and there's visibility and viability there. So hopefully that kind of covers.
So are you saying that, I mean, as I hear Harsh, yourself, and even Stalin earlier say that all of you, and I'm just using yourselves as an example, would bet on scaling up proven tech as opposed to first of its kind, as they say in your industry.
Yes.
Is that a fair comment to make?
At least for us, yes, Sanjay. We look
Okay.
for businesses where technology risk is minimal, but you actually take the business scale up risk, which is what we help companies.
Understand. How important is climate in the greenhouse gas measurement when you're looking at climate tech investments as part of a thesis? Because ultimately, while like you said, Harsh, that's not the only driver. The driver was efficiency, security, and cost, right? In the larger context of any economy. But this whole conversation or this whole, so-called climate tech got triggered because of the whole, you know, greenhouse gas impact, etc., etc. So how important is this measurement, tracking, using digital tools to see whether your investments are actually, making climate sense? Anyone?
Sure, I'm happy to give sort of the quick answer. I think it matters, right? Ultimately, um, your vendor, your customer needs to know it. I think that's part of the purchasing pattern, and you want to be able to articulate what's the value addition beyond cost that also drives, because I think these are now reporting standards that kind of go into all businesses. So if you look at e-mobility, right? Ultimately, it's companies that need to report, disclose, drive those changes. So we are measuring it at our level, but I think equally the companies and sort of the customers are thinking about it as well.
I take it that all of you think the same way on the subject.
Yeah.
Harsh, you mentioned when I cut you short, sorry for that, regarding the capital availability and bulk of the capital I've seen or bulk of the investments I've seen in climate tech, right? And one of the infras out of the equation and conversation has been early stage, seed, Series A, right? In very, very rare cases, Series B. Like rare is the word, right? And then, like we all know, in the private equity world, there's a Death Valley concept where you don't get money in the growth stage because you don't scale up. Uh, uh, is that a challenge you're facing in investments in climate tech in India? And can I request both Harsh, yourself, and starting to comment on this?
So, I think we have seen this challenge immensely from companies' perspective. We spoke to a lot of founders, and the consistent feedback was exactly what you said, Sanjay. So, growth capital is definitely a big gap, and then we also laid out in terms of where is the market, and clearly there are very few funds which are focused on the growth stage investment. And in fact, that's why the fund we are setting up, we are actually addressing that gap. That we actually invest in growth stage companies.
Starting I mean, any thoughts from your side on this?
Yeah, so I think that we look at this with perhaps a little more nuance. We disaggregated a lot of data in terms of where the investments were happening. And we actually see that like with angel networks, investments are happening up to about the 1.5 million range, often with the inclusion of foreign funds that are coming in for the lead role in many cases. We really see that there's a significant need for companies to have capital between kind of that 2 million to 10 or 2 million to 12 million range. And we've definitively seen through the partners in our network, both that there's a need for many of the companies to absorb debt during this kind of 2 to 12 million sort of investment range. Not right away, but generally, that pool of capital needs to be utilized to start building the debt readiness that would enable a debt provider to come in 18, 24, 36 months out. And so the conversations with debt providers need to happen very early, but that also reduces the amount of total equity that's needed for these companies to grow. We've also seen through our network of partners that there's plenty of investors that have been coming in and that are happy, both in sort of the mainstream, but wanting to see really viable businesses that are ready to look at companies that are ready to absorb a check of 10 million as part of a larger round, as well as from climate funds like Leapfrog. I think NIIF comes in a little bit later. Tata Cleantech is putting together a fund at that same rate or same stage of sort of the 10 to 12 million being kind of their first check size. So we really think that the market gap is kind of in this $2 to $12 million range. We further see that there's a lot of need for commercialization support in this because particularly we, at least as a firm, don't focus on direct to consumer products. We think that it's a lot harder to change minds than it is to change systems. And so when you look at something like the company I had shared earlier, the green silica company, we've been able to see how an entire industry started to shift because they had an economically viable, better chemical. We've seen similar things in the battery industry, in new materials. as well as a number of other sectors within our portfolio. But that's really about understanding what industry needs and taking the time to understand what their processes and quality standards are, what their commercialization cycle looks like, how many rounds of testing does that go through. And also because many of these businesses do have a requirement for physical assets, being willing to fund a first of a kind factory or a second of a kind factory.
Sorry for cutting you on this. When I look at your own network, what you call the Climate Capital Network, I see very good names in the VC side and the family office side, but you also see smaller check sizes, right? And to what Harsh mentioned earlier, and I've seen a bit of that myself, right? That it's still early stage investing, either because you don't have enough scalable opportunities or technologies are still while they seem to be scalable, but they've not really demonstrated that scale in terms of business model or revenue terms, right? Is that what you experienced too?
I think it varies. So what we've seen with the capital is that it has what's called a dumbbell effect in statistics, where you see that there's a lot of capital going into small deals in the up to 1.2 million range. And then you see kind of over the $12 million range that there's a lot of capital that's available, a lot of it being deployed, but also a lot of investors at that stage saying that they need companies that are kind of supported through this early growth and early commercialization phase. So we do think that there's a significant need in that stage.
Abhi, this question, if I put in context of global investors who you interact with, right, and their perspective on India in terms of investment, uh, any words you want to share? Any knowledge you want to share?
Sure. Can you just help me clarify that? So when you say global investors and perspective in India on
This is on the question of investments in climate tech, right? Because most of the investments in India are happening in the early stages, right? And there is a lack of growth capital. Are you finding that gap now being filled, or at least there's appetite to fill that gap from your investor base, as an example?
for sure, apps. I think India's done a phenomenally good job of trying to encourage new businesses. And I think VC system the VC ecosystem has generated a lot of investment as a result. We came in actually predominantly with the thesis that it's these businesses that Harsh very kindly put, which is the missing middle, need sort of runway on capital, and how can we come in as equity partners, but also bring in our entire financing ecosystem to drive adoption and de-risk their journey from where they are today to where they need to be for ultimate growth. I think increasingly so, more and more investors globally are looking at India, and that's just not for climate, but I think at large. So I think
So
climate.
you're quite bullish on the fact that growth capital will be found quite easily in the short to medium term,
I
even
want
though.
to maybe if I caveat that, I don't think growth capital in itself will be found easily. I think growth capital for good businesses will be found easily. The need to bifurcate that and distinguish that will become ever so important.
Okay, I'll come back to that. Then I'm going to touch upon this good businesses concept once more. I know we are running against time, but it's slightly a little late. I'm going to carry on with permission. Uh, a lot of the sectors of climate tech took off when there was a regulatory push by the government, right? That happened in EV, that happened in renewables, etc. Any high level thoughts on regulatory framework changes which are critical to actually make the different verticals of climate grow? Or Stalin?
So I think there is a global context and there is a local context. I think let's also be realistic. I think a lot has changed in the last 6 months since Trump started talking about drill baby drill, right? So I think a global ecosystem has definitely taken a little bit of backstep, and it's little is within quotes. Actually, there are lots of surveys which are, and we are seeing it on the ground also, that despite all the noise, there is continued optimism around climate investing. But What it has definitely led to is a little bit laxity in terms of disclosures around climate by companies. Where we see the opportunity in India is that SEBI has come out with BRSR standards, and that has put a little bit. Companies have started to think around, what should be their climate strategy, and in terms of disclosing that. I think we need to get that framework in place sooner than later. And of course, we've been working with some of the think tanks around that. The other aspect is that India also doesn't have its green taxonomy, right? So what exactly qualifies as climate is also a little bit of a question. Right now, people use their own definitions. Of course, one thing, as you rightly said, Sanjay, is around whether you have a CO2 emission reduction or not. But still, you need overarching framework around that. One interesting thing which we have found in India, the government has done, and we hope they can come up with similar frameworks for different things, is the EPR regulation, where actually the government didn't take the load, right? They basically ask the producers to take the load in terms of if you are supplying a material, you need to make sure its waste is getting collected, right? So I think some of those kind of frameworks will go a long way in helping accelerate push to climate. So reporting and some of the EPR sort of regulations. So that's what I would.
I would think like EPR you mentioned, even the biofuel policy has been a welcome,
Absolutely.
quick
Yeah.
move, in terms of the overall transportation. Andre and Craig were discussing how funds are looking at transactions, and while technology is a critical part, and I'm calling technology in a larger context, not necessarily digital twin and all that, but if I look back and look at the whole market in climate tech, it reminds me of yesteryears of telecom in India. There was a poster boy called Bharti created, right? And that became such a poster boy that it attracted billions of dollars in the sector, right? Uh, for a sector to take off, there must be poster boys, there must be failures, right? And there must be exits, right? Do you think this challenge is a real challenge right now in the climate tech investment thesis in the country? Starlene?
Maybe I'll go. This is
Harsh?
a topic which comes up quite often, and actually, it's very, very positive developments, right? Uh, One is, I would say, most of the renewable companies which we created back in 2011, 12 are, many of them have gone IPO, and they are all performing quite well. So that is a good news. I think that has created a benchmark in terms of people to follow. And a lot of the other businesses, are also taking that lead, at least companies which have achieved 500 crores plus of revenue. They are all thinking of going to the IPO market. 5 years back, this was unthinkable. What is the most interesting part, Sanjay, is that a lot of the companies, slightly mature companies on the growth stage side, they are finding a lot of favor from pre-IPO investors as well, because they are seeing a lot of hunger for new sort of businesses which have reasonably well established metrics. So in fact, India in that sense has changed significantly in the last 2 years, and I'm very optimistic about some of these businesses getting listed.
Starlene, are you finding exits in your invest portfolio more secondaries and M&A?
We definitely see that there's a much stronger push towards the IPO markets, but we're also seeing that there's a lot of strategics that are looking at the sector. In fact, we have certain areas where when we're doing exit planning as part of our diligence process, we've actually had one or two companies where, because we know of the level of strategic interest and the likelihood that those buyers might squeeze us on price, we've actually opted not to move ahead. But I think I wanted to just touch back on like the prior point around sort of government and the market, which is, I think that the government has the ability to put a lot of positive momentum into the market by encouraging or creating regulations. But I think at the end of the day, what fundamentally is going to shift the needle is the companies that are really in a position to displace high emission incumbents based on market superiority. That's really what we aim to look at. And we think that there's a lot of those types of companies in the market already. And we've seen already, for example, a number of companies like in the climate drone space that have even went into IPO and been like 900 times oversubscribed. That's not from our own portfolio.
Let me share with you some hard facts. I did some recce on IBO and climate tech over the last few years in India, and I've came across less than 20. I'm not counting the infra guys, right? I came across less than 20 companies, right? And not a single company which is a poster boy yet. I'm not taking away what you're saying. I'm purposely, right, bringing this up because this IPO thesis sometimes becomes overstated in India, right?
I fully understand that, Sanjay, but I'd also say like in 2015, and I saw that Karthik from Sangam or Synapse is on the call too. When we were looking at investments in 2015, there was nobody doing venture investments really. And so to assume that there should be a bunch of IPOs when investments weren't happening is, wishing for rainbows without rain.
No, I'm with you. I take it that we all hope that there'll be many more green stocks of caliber in the market, just the way we found them in other sectors. One last question to all of you, right? So if I look back at the whole development of the VC space in the country, right? It happened over the last 25 years, and there were periods. There was a distinct period where a lot of investment went into the internet, stroke e-commerce. And then there was a lot of investment in the mobility side, right? There's a feeling I have, and many people are speaking about it, that climate tech is the next big story for investment, and therefore, as time goes by, the many new stars will be created. Um, do any of you feel that there'll be what I'm calling a green swan event, which will happen as opposed to black swan, but equivalent in the climate tech space in the future from India? And a request if each of you can just address that. Is my question quite clear?
Okay, so having been at a hedge fund when the financial crisis of 2007 to 9 happened, or 2008, however we like to, and been through what was called like a black swan event, I don't know that we're going to see something of that caliber that is the green equivalent. I think that this really is kind of like an industrial revolution, but it's going to be something where it takes 20 years or 25 years of year-on-year growth at accelerated rates through those years to see kind of the transition of the larger economy. So I don't think that we're gonna, unless you have a scenario where there's just like such a dire emergency, I don't foresee it being a green swan event, and so that would be
But you're positive in the overall outlook in the space, obviously.
absolutely.
Okay. Harsh and Abe, would you like to share a quick bit on this?
Yeah, I'll be quick. Look, I think promise is there. I think climate tech in India, the promise is indefinite. I think there are more capital sources than ever before. And more importantly, there are more entrepreneurs and business models that are emerging than ever before, and that's supporting the ecosystem. If I use a cricket analogy, I think this game is more singles and doubles rather than a 4 or 6. And I think if you can convince and demonstrate good returns at the early VC stage, which capital can then get recycled into mid-market and then eventually buyout. I think, and then for strategics, then for public markets, I think as you get those wins over time across the different elements of capital investors, you'll find a very mature market in about 5-10 years where more risk is there's more appetite for risk. So I think it's the singles and doubles that'll get you to where we
Got
need
it.
to go.
Harsh?
So Sanjay, actually, I kind of echo. I think it's a slow burn, of course, in terms of the overall change in the dynamics. But I actually, it's interesting. I was actually thinking about it a few days back, and if we think of healthcare, the way this industry grew, right? Back in, if we were on a panel about healthcare investments in 2017, 18, most of the people were talking about same things are not changing, people are not health conscious, there is less demand, etc. And boom, COVID happened, and then everything changed. The healthcare has been the best performing investment category across the world, right? So can something like that happen? I mean, I hope so, but I mean, I hope not, because that will also come at a lot of cost to human being. So that's the context, right? I mean, hopefully we change our ways, and the slow burn actually lets us get to a place where the world is a better place to live in.
Well, on that note, well, thank you, panelists. I know we have few questions, but I'll just summarize. I think what I hear everyone says that there are many investment avenues. Technology is critical, but ideally, not always. Proven technologies is better than totally new for scaling, creating scalable propositions. At least in the Indian context, so far there'll always be new technologies which will come into play in different segments, which will be relevant for the market. Right, this market is slated to grow substantially, but there may not be quantum jumps in investment. And it seems that as more and more companies get created, uh, the so-called growth capital will also come into play and be available, finding lots of secondaries, M&A, and of course IPOs. On that note, I thank the panelists for this. There are two questions I will just take. There is a question from Louisa on the circular economy, whether there's significant investments happening around that. And there's another question from Nishant on funds managing credit risk. I think something which was spoken about by earlier panelist Andre at Strides. But would you like to take the circular question, Starlene? And can I request Nishant if you can take the credit risk question?
Sure, happy to speak on circular economy. We definitely see that there's a lot of early stage interest in circular economy, sort of in the angel and seed stage. We ourselves as a fund are very excited about companies that are not necessarily in the mainstream circular economy space, but we very much love businesses where we're seeing really innovative products around waste valorization, where you're seeing waste being used to make green chemicals or other base products that otherwise are quite expensive to import into India, and are competitive with or have a lower cost basis than their traditional peers.
Thanks. Harsh, any perspective on credit in this market? Although this was spoken about by the earlier panelists at Stride.
Yeah, no, I think I would. I don't think I would be in any better position than what Andre would have covered, because he's running a credit fund. I mean, I do agree with what Andre was saying, that there is actually a lot of opportunity on the credit side in the climate space.
Abe, any thought you want to share on this subject?
The credit, yeah, I think broadly on governance, payment risks, and commercialization of growth, I think for us it's view on TCO, right? So as long as it makes business sense, you go after businesses that are large, that already have a lot of the right governance and payment mechanisms there in place, and then it's injecting a climate business model or a solution into that ecosystem. And so we found that to be the most effective in getting the right outcomes.
All right. Well, with that, thanks everyone. Thanks for sparing your time. Thank you, IVCA, for hosting this. Over to you.
What a fantastic conversation. Thank you so much, Stalin, Sanjay, Harsh, and Abhay, for sharing your very valuable insights for us. Now, to close the session, it's my privilege to invite Pratibha Jain of Everstone. She is also the co-chair of IVCA Climate and Sustainability Council to share her closing remarks. Over to you, Pratibha.
Hi, can you hear me?
Yes, Pratibha, you are audible.
Lovely. Okay. That was a very insightful 1.5 hours, everyone. Thank you so much for the insights, all the speakers and the panelists. I think when you start talking about climate investments, the main thing today, and hopefully, we can overcome this soon enough, is, getting the finance. I have now been in the operating in the Indian markets for more than 20 years. And I think over time you will see the sector develop. And like Harsh was mentioning, when we were doing pharma before this, just before this infrastructure, we all wondered where the capital growth will come from. And now, there's enough and more interest in the sector. So I am very, very hopeful for the growth, especially with the kind of players and the kind of talent that we are seeing in this market. I'm also very mindful of all the interesting insights on where the climate finance is going. As you know, I am part of Everstone Group, and Everstone Group is more focused on the developed stage of the market, and seeing the gap for finance, especially for growth investments, makes you think the importance of making sure the money is flowing into all the sectors. What we didn't discuss much in detail, again, Craig mentioned it a little, Harsh mentioned it a little, but the importance of policies in this area, that's where I play. I think there is a lot of scope, whether it's investments in early stage growth or the developed sectors. You really need the government to step up here, from making sure that there is enough finance coming into the country and policies to support it. I think every step of it, we need the government to kind of get more involved, and more at the central government level. I think this requires interest from the Prime Minister's office, the Ministry of Finance, and shouldn't be something that's left to MNRE and the other sectors. I think IVCA has been playing a very important role in ensuring that that happens, and support from the industry to IVCA to provide that policy support is very, very critical. So if we can take the comments we had today from all the important speakers and the panelists, and Mudit, take especially the insights into not having enough money on the growth side, and take that to the government. I think that'll be really something concrete that IVCA could have done. I know we are running late, so I'm not going to take much more time, but just thank all of the speakers and the panelists for their time, and use this to plug in for the next important event, the IVCA annual event for this council is on 24th and 25th November at Bharat Mandapam. So it's where we get all the policymakers, the government, and the industry, and the private equity and the venture capital players get together to ideate and further the climate investment landscape in India. So really looking forward to having all of you there. And with that, we can close for today.
Thank you so much, Pratibha, for the inspiring closing words. And with that, we'd like to conclude today's IVCA Green Future Series webinar. A heartfelt thank you to all our speakers and to each one of you in the audience for joining us today. And I would like to request you to stay connected with IVCA, and we look forward to welcoming you again very soon. Thank you so much, everyone.